Hey everyone, thank you so much for joining the podcast today. Once again, we have Jeff Nash of Bridgemark Strategies on the podcast just to discuss a really important topic and a question that we get from financial advisors all the time. Am I getting a good deal? A lot of financial advisors don't know out there. There's really no Zillow out there to really compare the deal that you're getting from different firms. One like-size firm getting an offer from another firm, what to potentially expect. And we get the question from financial advisors all the time. Am I getting a good deal? After we help them align with the right firms, after we help them ask the right questions, they just want to make sure that they're getting compensated appropriately for the risk of making a move to another firm. And combined inside of our team, we've seen thousands and thousands of deals and just wanted to share some of the insights we coach our clients on along the way when they're doing due diligence to make sure that they're maximizing their offer when they're considering a new firm. Jeff, I appreciate you hopping on and offering some
Excellent.
insights.
Yeah, absolutely. Love it. Thanks for sharing. And I think this podcast, while we set this up a few weeks ago to talk today, it's kind of timely. I actually had a conversation with a client this morning on this exact topic. And again, kind of going through the life cycle with this particular financial advisor as a client, we helped him evaluate which firms would be the right firms for him. We helped him compare the pros and cons. So he's kind of got it narrowed down to two firms and likes one over the other. And he's really trying to help understand the overall economics and where there's room to negotiate. In fact, the firm he likes the most is actually not the best deal in a traditional sense. And he's wondering, hey, what else can we negotiate? How do we get a little bit more out of this, et cetera? And so we had a lot of detailed conversation on this exact topic just this morning. And it's the question that everybody wants to know, right? What's out there? And how do I know? How do I compare? How do I turn over the stones? One of the things that we've seen is a lot of times financial advisors don't even know the entire kind of makeup of their deal. When you're going W-2 to W-2, it's heavily tied to just the upfront money, but also what's the timeline and what's the amortization table on that upfront money, right? That forgivable note. What are the interest rates that might be charged, right? There's a lot of other questions that ask. When you go to a 1099, an independent firm, questions that come up are not just about the deal itself, which are similar questions in the W-2 world, but about the overall payout and the platform fees and the support. A lot of these things can actually be negotiated.
Yeah, 100%. I agree. And we'll definitely cover all of those line item by line item. But, economics are really important. There are, especially breaking free from a W-2 channel to another firm, potentially starting your own business. I mean, financial advisors most of the time want to be compensated, very fairly for that risk that they're taking on. And on the headlines today, if you take a look on any of the publications out there, you're seeing advertisements specifically from firms with X amount of basis points of your trailing 12 revenue or percentage of your trailing 12 revenue. You're seeing, large teams that have moved with, deal details inside of there. And sometimes these deals will apply to, a specific financial advisor and sometimes they won't. So, when a financial advisor asks me, how do I know that I'm getting the best deal? I think a big portion of that, number one, is just making sure you're aligning them with the right firms. The firms that really, specialize in lifting people out from that specific firm an advisor is thinking about breaking away from. I guess in short, not all deals apply to all advisors.
No question, right? I mean, it's almost like if there were a disclosure statement, which there isn't in this space, because there's a headline number that we often see, and then there's a real number that can be much different than the headline number. And a headline number at one firm may look great, and the real number at that same firm may be much less than what somebody thought, and the secondary firm could be better overall when you factor in all those factors. And so it definitely starts with picking the right firm. I 100% agree on that, because otherwise you're negotiating against yourself if that really is the case. When it comes to, right, so just to touch on that really quickly, one of the things that we've seen, and we have this expression that many of you have heard who's listened to these podcasts about feel, fit, and financials. And feel is around culture, right? Picking the right firm that you're philosophically aligned with. Fit is around the business itself and making sure they can support your clients. And then financials are what they are. And what we see with feel, fit, and financials is when advisors put too much weight on financials, right? and maybe they're negotiating for themselves a really good deal, but they're overemphasizing and putting too much weight on a financial, you could actually set your clock, more of a calendar, I guess, but you set your calendar to it where you know in 2 years or less, that advisor is going to be unhappy. And more often than not, they're signing a 10-year deal. And that's a problem if you're unhappy at 2 years and you picked the wrong firm. So it's really important to start with the right firm before you kind of dig too heavily into the financials, right? And making sure that you're at a firm that's going to be with you as you grow and as your business grows, because it is going to, the industry evolves, clients evolve, the business evolves, all of these things evolve. And you definitely want to pick a firm that's right for you today and also philosophically right for you, because that means you're more likely to evolve together.
For sure, 100%. A decision should never be made off of economics alone, but just for the purpose of this call today, since we're, having conversations about economics, I really think one of the ways that we really help in the process is just to help financial advisors understand what a realistic offer looks like. I mean, I'll give you a perfect example. I've been working with a really large bank advisor for the last couple years. They're taking a huge risk making the move from a non-protocol firm, potentially looking to go independent. They want to get paid for that risk. And so far over the last couple years, they really haven't seen a deal that has made them feel like they're getting awarded for the amount of risk that they're taking. Things are going pretty well at their firm. They're growing at a pretty steady clip. So no reason for, taking a huge risk. But the other day, they saw an article in one of the large industry publications of a firm that got a huge amount of basis points on their assets under management, close to like a $20 million deal to make a move from one firm to another. And the advisor called me up right away and said, Corey, I mean, this is the deal I want. I want to have a conversation with this firm right away. And I kind of told him, let's pump on the brakes. That's more for an independent to independent move where a financial advisor is going to bring, 100% plus of their business with them in a transition. It's not designed for a bank deal. So, just helping him understand that probably saved him, 15 plus hours of time, him not providing reports, having conversations with the firm, doing tech demos, going on a home office visit where upfront economics were never really going to work in the first place. So that's not necessarily maximizing, but that's just something that we kind of do to help advisors level set and kind of filter through some of the sales sizzle that's out there in the industry.
I think it's so on point, right? And the example is so apropos, where advisors are taking a risk, right? They're moving their client from an established known scenario, right, their current firm, to an unknown scenario, and they're trying to do their due diligence as best they can. And again, sidebar, this is where we can help them with that. But they're trying to do their due diligence as best they can to find the right firm and making sure and taking that risk. And a lot of advisors feel as though the firm should be providing them with capital to have them take that risk. And the reality is there is some opportunity for that. But you have to understand from the firm's perspective is the firms are also looking at taking risk as well. The firms look at recruiting as a portfolio and they look at it as an investment, almost as if a financial advisor is buying a stock for a client. That financial advisor themselves is a stock. Is it a stock worth investing in? And then is all of the financial advisors they've recruited a portfolio or a mutual fund? It's a portfolio of stocks, and are they overall worth investing in? And so the firms now know most of the case where advisors coming from one type of firm or even one named firm will have a more historical success rate. And so there's a legacy, there's even a baggage brought to the table from these firms that are giving transition money saying, hey, we know what you're going to do within some range. And we have a really good sense of what that's going to look like. And so we're going to provide you this amount of money. And so the opportunity for where we help advisors is not just looking at the right firms. It's not just helping them with the actual deal or the overall economics, more than just the deal, the ongoing compensation, right? But it's also how do you present the advisor themselves and the advisor's numbers to actually maximize those things. And so there's an opportunity for presentation as well as negotiation to really enhance overall packages. And that's an important component to negotiating with an individual firm. Like I said, these firms have been doing recruiting for years. I've been in this business for 25 plus years just doing recruiting. And there's a long track record from a lot of firms. and they know advisors and they know from where they come and what they would expect, and not just what they would expect, but literally what they would expect in year one, year two, year three, and how they would grow. And there's a blend of averages, and that's how they price out a lot of advisors.
Yeah, so I mean, just to add on to that, Jeff, $1 million of production or $5 million of trailing 12 production, versus another 5 million of trailing 12 production can be two completely different stories when it comes to, upfront economics. The amount of fee-based concentration, certain type of products that they use, all of these go through specific underwritings. But one thing that has really helped me in the past is just like in the acquisition world, we've talked about many times, showing financial advisors strong historical growth up and above, just the regular market growth that's out there in the industry is just one of many things that we can show to put an advisor in like a really good light to a firm if they're in fact asking for some extra money.
Yeah, no question. A lot of it comes back to growth and retention, right? And this is like in the M&A world, which is PE backed typically by RIA firms that are buying advisors' businesses. It's all formulaic for them. They're looking at 3-year net new asset, right? They want to see 3-year track record on growth. They want to see any client attrition over the last 3 years. They want to see the product mix. They want to see all of these numbers over a 3-year trend line. And so they can get a really good sense of what it is that they're buying from this business on not just a 1-year basis, but on a multi-year basis. And then they'll pay up for that business, right? Those businesses will be eligible for higher EBITDA multiples that have those track records. And the BD space isn't as formulaic, isn't as often looking at the 3-year average, but there are ways that we've had success in helping firms and helping advisory teams, really be able to maximize their economics in picking the right firm, right? So again, to say that same statement again, I want to highlight that it's maximizing the economics when picking the right firm. It's not about maxing the economics in any firm, right? It really does come back to picking the right firm. And those maximized economics may not actually be the best economics. That's when you know you've made a good decision, is you're picking the firm for all of those other attributes that we talk about, and then you're trying to maximize those economics.
Hey, breaking in real quick. I really hope you're enjoying this episode and finding my YouTube channel of value. If you're a high performing financial advisor that can use somebody as a guide or a resource to explore all your transition options out there in the marketplace, I'm a non-biased, independent transition consultant that can help make this process so much easier for you. And another plus, it costs absolutely nothing to work with me. If you want to have a conversation, please feel free to text, call, email, DM me. My contact information is all over this episode, and I'll let you get back to it. Let's say we have it narrowed down to, two different firms, Jeff. And, we started out with five. We worked our way down through fit and culture, and we're down to two different firms now. Now it's time to start negotiating, maximizing, the economics for the potential new firm. What are some of the mistakes that you're seeing financial advisors make? I mean, we've done this thousands and thousands of times. What are some of the things that can get financial advisors in trouble?
So for advisors looking to go 1099, independent broker dealer, or hybrid, right? The number one mistake that I see from those advisors is they actually get focused on payout, right? So transition money is important. That's a headline number. That's got a lot of marketing pizzazz, if you will, sizzle, we'll call it. That's got a lot of sizzle. And certainly there's an important number in there that we can dig into as to how to maximize that and things along that. So we'll come back to that. But I think the number one mistake is advisors they miss platform fees or program fees. And that's the number one mistake. So they think about payout, they think about transition money or promissory note or forgivable note, and they miss platform fees. And in some cases, these payouts can be dramatically undercut because of platform fees or program fees. And different firms, by the way, call them different things. So it definitely has to be something that's dug into. There are different firms will have breakpoints, they'll have householding, there's different ways to considerations. But for a business that's mostly fee-based asset management, these fees can be significant as a percentage of overall payout
Hmm.
to the broker dealer or RIA that you're affiliating with. And so that's definitely one area that advisors should be paying attention to. And yes, that is an area that can often be negotiated.
I love that. There's so many things that can be negotiated that we help, walk financial advisors through. There's never been a more competitive time in the industry for an elite advisor to be able to have their cake and eat it too. I mean, there's tons of things that you could negotiate in the process right now, but you can't have them all. It's just important to understand when you go through this process. Yes, you deserve to make money, you deserve to get rewarded, but so does the firm that you're joining as well. And there's things that could be negotiated like payout, platform fees, errors and emissions insurance costs, other fixed costs, affiliation fees, technology fees, ACAT fees or account transfer fees when you're moving from one firm to another. You have the ability to negotiate all of these things. You just can't have every single thing. So we work together with you throughout the whole process to just really figure out what's really, really important to you so we can go back to a firm and ask for things that are fair. So it's a profitable deal on both sides. So Jeff, one thing that I would say is a big mistake as well that I will add on to, sometimes I will work with a financial advisor that has already had a few conversations with me with a firm prior to having a conversation with me. Maybe they've moved zero once, twice in their career. So over a span of 30 years, they haven't had a lot of experience doing this. And they'll work with a recruiter and they'll start getting economics over time. They'll start getting a profitability analysis. They'll start learning about the overall cost of the firm. And as they're going, they're asking for different things. The recruiter is going back to management. Management is bringing that back to the finance team. And every single time that they're asking for something new, the firm is spending a ton of resources figuring out if this is something they could do, something that's really, really profitable. And after the fifth or sixth time that a financial advisor goes back, the firms wind up getting really, really exhausted. They just don't want to spend any more headspace or firm resources on the deal anymore. So, one of the things that we always coach a financial advisor that we're working with is, you know, as you're going through this process, let's talk together and kind of build a list of must-haves that you're going to need in order to make this deal work. What's feasible. And once we get down to, the final days of making a decision, come to them with the A, B, C, and D things that are really, really important. And in return, get a signed contract with a specific date in mind. And that's when you're going to have the most leverage. You're being courteous to the finance team and all the other people inside of the firm. And it's just your best chance of getting what you want instead of slowly chipping away at them.
The goal in the recruiting process, and a lot of advisors don't really understand the actual goals in the recruiting process. The goal in the recruiting process is to be in the driver's seat during the whole process. And so you want to evaluate the firms and have all of the control. Well, newsflash, the firms actually want that same thing. They're actually evaluating you and are also looking for all of the control. And so what Corey was just talking about of not wearing out the process, one of the things that we actually coach on is how to have the firms fall in love with the financial advisor, right? The more the advisor is loved by the firm, they see him as a really beneficial addition to their team, right? Then the more they're going to be willing to negotiate. And the more, and the opposite is also true, is the more they're drained of resources and they see that this process is kind of dragging on or being drained or not really, hey, it's an advisor we just like, we don't love, then it's going to hurt your overall. And so the key to some of this is when you're looking at negotiating, there is a style and style points matter when it comes to negotiating. And the key to this whole thing is you're actually selling yourself. Never misrepresent yourself. That's the number one most important thing. Never ever misrepresent yourself. But you are selling yourself to these firms, getting them to fall in love with you as much as they can, getting them to like you, your team, everything that you've built. And that is how you will help yourself in that negotiating process.
100%. That's a great way to put it. And that's also going through the whole process, right? That's having a conversation with the recruiters. It's having a conversation with leadership. It's, going to the home office and meeting with, the high up leadership that at the end of the day, if you're asking for something up and above what they've given you, they're the person that's going to wind up signing off on the deal. So, I mean, it's really important as we talk about feel, fit, and financials for them to really have that strong feel about you as well. I agree 100%.
Yeah, and you always want to be obviously be genuine, never misrepresent yourself, but be yourself. And we've seen it. We've seen it countless times where advisors on the other side of that, they came across as a bit aggressive or whatever it was, and the firms say, "Hey, we like them, we don't love them, we're done. We're not giving a better offer. That's as good as we're going to get." We've seen that again countless times. And when we do see that, candidly, there's not a lot we're going to get out of that firm, right? So the choice from the advisor at that perspective, if you're down to two in your example, Corey, is you may that firm you might like the best may not like you the best, and so that will drive your choice as to maybe you end up going to firm number two or B on the list. So it's really important to understand that you're being kind of scouted and recruited, but you're also being evaluated, and that evaluation will also drive negotiation. So to pivot for a quick second here, I think the other thing just to real talk about as we're talking about economics and negotiation, I think there's a couple things to talk about. Number one is not everyone's, and we talked a little bit about this, where not everyone's numbers are the same. So a $5 million team and two different $5 million teams can be totally different, get totally different packages. Again, I've referenced the M&A spaces as from previous podcasts, folks know that I do a lot more in the M&A investment banking space. And we see that where we do M&A deals and we get to what we call equilibrium pricing. And equilibrium pricing in the M&A space is a multiple on EBITDA that we start to see firms coming in all at the same multiple, right? So it's kind of known by the industry of, hey, this is how we value this. But what's different in that is where we have a lot of opportunity for negotiation is we can actually impact and improve overall EBITDA with tactics and negotiating. And if you improve overall EBITDA on the same multiple, you're going to get a better price. And the same is true for recruiting. You don't have as much control to affect your payout or, excuse me, your product mix and things along those lines. But there's a lot of opportunity to really look at your numbers and to present your numbers in a manner that maximizes your opportunity set. And so that's important to working with a consultant that understands the landscape so that you can really try to maximize that. To be perfectly honest, it doesn't always work, right? Sometimes the numbers are what the numbers are, but we know that there are opportunities and we've had success in those opportunities to enhance deals beyond what were even kind of, hey, we're already at our max, and we've actually had opportunities to enhance deals to get firms thinking about things that have been different.
Yeah, I mean, in short, we're just going to be able to see things that you might not see. Not
Yeah,
because
well
you're
put.
not because you're incapable, not because you're not smart, just because you just haven't seen as many deals as we have because we do this all day, every single day. So a perfect example, Jeff. A couple months ago, I was working with a $2 million trailing 12 revenue advisor. He had 20 basis point platform fees, and at this specific firm, and a lot of firms are like this, they take the platform fees out of their trailing 12 revenue numbers. So this advisor was doing 2 million of trailing 12 revenue, but when the other firm took a look at his numbers, it looked like he was doing 1.6. So we got all the way to the end and we were talking about negotiating, and the advisor didn't really know where to go. And I took a look at some of his trailing 12 production reports, and I just saw how it was flowing through the production reports. And he made another $400,000 of money just by moving from a $1.6 million producer to a $2 million producer in those advisors' eyes. What a lot of people know is these recruiters get paid on trailing 12 production. We get paid on trailing 12 production. Like, you have a lot of people on your side to make sure that that's maxed out in your deal. And that's just one specific example on how we just help someone see something that they probably would have gone unnoticed. Well, Jeff, I really appreciate you hopping on the podcast today, as always. I know we've been talking about doing this for a while. For any advisors that are out there that have any questions about this, please reach out to us. As I mentioned in the beginning of this podcast, us and the 13 other consultants on our team, we're constantly having conversations with each other, understanding where deals are, understanding where we can possibly help other advisors benefit in some places that they might not know about. We see these deals all the time. We know how to negotiate them. Can help you just make sure that you're making a really confident decision and you know you're getting the best possible deal you can at the right firm. So
Totally
really
agree.
appreciate the time.
Yeah, Corey, and I agree. Thank you for doing this. I mean, just to add one last thing on top to what you just said, which is, first of all, thank you for doing this and thank you for hosting. It's interesting, even this calendar year, we've seen firms, like one specific firm has had a bit of a almost a roller coaster in their deals. And some of it is we've seen early indicators where, hey, their deal is going to be going up. And so we've kind of been able to where their deal was slower at one point, and then it's higher again, and then it was lower, and then it was higher again. And some of it, we were actually able to get in front of it to help advisors kind of wait, play it a little bit, and then be able to get the better deals. A lot of firms don't want to just rewrite when they change their grid, and they don't want to just go back and rewrite everybody that they've already written and give them a higher grid. So there's definitely some we've had some opportunities to be able to do that as well this year. So it's like I said, if we can help, it's our pleasure to be able to help you, and don't hesitate to reach out.
Thanks so much again, Jeff, and I hope everyone has a great day.
Thanks all.